It's 8:02 a.m. You're in pajama pants. Your coffee is perfect, and you're already at work. Your commute is 7 steps past the dog. Your desk is a real desk, not the corner of a wobbling dining table with crumbs from last night's pasta. Somewhere inside this domestic paradise sits a quiet superpower the IRS will happily let you use, if you play by the rules. It's the Home Office Deduction. Start with the Golden Gate, exclusive and regular use. The space you're claiming must be used only for your trade or business, and used that way on a steady basis. Not sometimes, not on Thursdays when the cat permits. A real defined area. It can be a whole room or a clearly marked slice of one, but it can't moonlight as your guest room, your gaming lounge, or your toddler's trampoline park. If a stranger could walk in and say, "Yep, this corner is obviously the office," you're on the right track. Take a photo, draw a quick floor plan, save both. Your future self will thank you. Now for the second test, principal place of business. You win if you meet clients there, or if it's where your admin and management actually happen, and you don't have another fixed location for those tasks. In practice, that means your invoices, your planning, your calls, your editing, all the glue work of your business live here. You do photography on site all over town, but edit, bill, market, and manage from this desk. That desk counts. If you run therapy sessions on Zoom from this space, it counts. If you have an outside studio where the admin lives, the home space usually doesn't. The test cares about facts, not vibes. There are 2 glorious exceptions to the exclusive use stickler. First, qualified daycare. If you're licensed or otherwise meet your state's requirements, you can use the same space for kids by day and Netflix by night and still claim a deduction. Your math just adjusts for hours of business use. Second, inventory or product samples. If your home stores goods for sale in the normal course of business and there's no other fixed storage location, you can deduct the storage area even if the rest of the room is mixed use. Shelves of candles in the garage? That can work. Let's talk who gets to claim. Self-employed people filing Schedule C are the core audience. Partners and S-Corp shareholders don't take it on their personal returns. They should use an accountable plan for reimbursements from the entity. Regular W-2 employees can't deduct a home office on their federal return under current rules, even if the boss sends you Slack messages at 10 p.m. Some states still allow an employee deduction, but federally, it's off the table for now. If you're both an employee and a side hustle founder, you can still claim for the business. You just separate the worlds like church and state. You've passed the philosophy, now the math. The IRS gives you 2 paths, the simplified method and the actual expense method. The simplified method is the stress-free brunch option. Measure the office up to 300 square feet, multiply by $5, and you're done. Maximum deduction, $1,500. No depreciation, no spreadsheets, no Form 8829. You still deduct your mortgage interest and property taxes on Schedule A as usual if you itemize, whether or not you use the simplified method. It's perfect for small spaces or thin years. The actual expense method is for people who enjoy a bit more juice. You separate expenses into direct and indirect. Direct are repairs and costs, only for the office. Repainting the office wall, replacing that office window. Those are 100% deductible. Indirect are the household-wide items you allocate by business use. Rent or mortgage interest, property taxes, homeowners or renters insurance, utilities, HOA dues, security, garbage, and the big one everyone forgets, depreciation of the business portion of your home. You'll measure your office, divide by your home's total livable square footage, and get a business use percentage. Apply that percentage to the indirect expenses. If your office is 200 square feet in a 1,000 square foot apartment, you're looking at 20% of the shared costs. Repairs versus improvements is the next plot twist. Fixing a broken outlet, patching drywall, cleaning ducts, that's repair. If it's exclusively in the office, it's fully deductible. If it benefits the whole home, it's allocable. Improvements, new roof, major remodel, adding built-ins, get capitalized and depreciated. And yes, if your home office is part of the dwelling, the business portion of your home is depreciated over a long life. Think multiple decades, straight line. Translation, you don't get the whole cost now. You get a slice each year. If this sounds dry, here's why it matters. The slices add up, and they also set the stage for what happens when you eventually sell. Before we talk sale, record keeping. You don't need an architect's blueprint. You need clear, boring evidence. Take photos of the space. Sketch the floor plan with measurements. Keep your lease or deed, plus utility bills, insurance, HOA letters, and repair invoices. If you're using the actual method, file Form 8829 with your return. The simplified method doesn't require it. Keep it all for at least as long as the statute, plus the years you're depreciating. Nothing destroys an audit like clean PDFs. Phones and internet live in a gray alley of their own. Your first home landline isn't deductible. A second dedicated business line is. Internet can be allocated by reasonable percentage of business use, but it's not part of the square footage office percentage. It's its own line item. Your cell phone works the same way. Figure out a realistic business percentage. If every call is a client call, it's high. If you're mostly texting your cousin, it's low. Reasonable, consistent, and documented wins the day. Renters, you are absolutely invited. You don't depreciate the building, but you can deduct your share of rent, utilities, renter's insurance, and so on using the same square foot math. Homeowners, you spread love across mortgage interest, property taxes, insurance, utilities, and depreciation. If you itemize, remember, the portion of mortgage interest and property taxes you assign to the business won't also appear on Schedule A. You're not double dipping, you're reallocating. The leftovers still live on Schedule A if you itemize. Let's do a quick, clean example. Your one bedroom is 900 square feet. Your office nook is 180. That's 20% business use. You pay $2,000 a month rent, $150 for electricity, $60 for water and trash, $80 for renter's insurance, and $90 for internet. You had a $300 direct office repair, new light fixture, installed only in the office. Under the actual method, your rent deduction is 20% of $24,000. Your electricity is 20% of $1,800. Water/trash, 20% of $720. Insurance, 20% of $960. And internet is whatever your reasonable business percentage is, say 70% of $1,080. The light fixture, 100%. You add them up, and that number drops right onto your Schedule C. If you'd used the simplified method, you'd have stopped at 180 square feet times $5 and called it a day. Will the deduction create or increase a loss? There's a special cap. The home office deduction can't push your Schedule C below zero, at least not the portion made of things like indirect expenses and depreciation. If it does, the excess carries forward to next year when you, hopefully, have the profit to absorb it. Direct expenses can often be taken even in a loss, but the general rule keeps the home office from generating negative income by itself. No, that's not mean. It's a guardrail. Now the question everyone whispers. Does claiming a home office hurt me when I sell? Here's the clean version. If the office is within the four walls of your home and not a separate structure, you still qualify for the home sale exclusion on the gain from your main home when you sell, subject to the usual occupancy and ownership tests. The carve-out is depreciation. Any depreciation you took or could have taken for the business portion is recaptured and taxed up to a special maximum rate when you sell. If you use the simplified method, you didn't depreciate, so there's nothing to recapture. If your office is in a separate freestanding structure, say a detached studio, gain on that portion doesn't get the main home exclusion. For many people, that distinction alone tips them toward the simplified method or a modest actual method deduction, with eyes wide open about future recapture. There's no villain here, just math. Just let's step into edge case alley. Can two spouses each claim the same space? Not the same square feet, but you can divide the room in truth and on paper if you both meet the tests for separate trades. Can roommates each claim? Yes. If each has an exclusive, regular use area for their own business. Can an artist claim the garage while cars live there at night? Not exclusive. But if you wall off a zone for canvases and the rest is for vehicles, you can claim the walled off zone. Can you deduct lawn care? Generally no, unless the exterior property is part of a claimed area for meeting clients, or your home office is a separate structure where the grounds are genuinely part of the business's public face. The bar is high. Most people don't meet it. Can you negotiate with your LLC or S-Corp to rent your home office? That's a thing in some structures, but it's delicate. Use an accountable plan reimbursement instead, with receipts and a clear policy. Keep it boring. Audit nerves? Here's what raises eyebrows. Dining table offices. Houses where the office is also a guest room with a bed in the shot. Deduction percentages that mysteriously change every year without a remodel. Internet at 100% business for a household with 5 streaming teenagers. Home office deductions for a business that clearly runs from a separate studio on Instagram. What calms eyebrows? Photos with dates. Floor plans with measurements. A calendar showing consistent work in the space. Utility bills, repair invoices, and a Form 8829 that ties out cleanly. Auditors are human. Show them a tidy story and they exhale. If you're running daycare, your math gets an extra multiplier for business hours. If you're storing inventory, you measure the storage area and claim it even if the room isn't exclusively business. If your business is seasonal, regular use means consistent during your season. You don't fail just because your office naps in January. If you move mid-year, you can claim the old office for the months you used it and the new one for the rest. Just track square feet and dates so your percentages are honest. There's one more subtle benefit almost nobody talks about: discipline. When you carve out a real office, you tend to run your business like a business. You keep contracts in one place, you save invoices, you reconcile monthly instead of guessing in April. The home office deduction is a tax win, but it's also a behavioral nudge. If writing off 20% of your utilities is the price of becoming the kind of founder whose books always make sense, that's a bargain.